Welcome to This Week in Money. I'm Jim Goddard. Today, Mish Shedlock, editor of Mish's Global Economic Trend Analysis, tells us China would do the whole world a favor if it gave its steel production away. He'll explain how that works. Rick's Picks editor Rick Ackerman talks about U.S. corporate earnings falling for the last 6 quarters and what that means in the long run. We'll talk to Mish Shedlock right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Mike Shedlock. You can find him on mishtalk.com with Mish's Global Economic Trend Analysis. Welcome back to the show, Mish.
Pleasure to be on.
What do you think the long-term trend is for the equity markets? Are we going to see one big blowout, or is it going to go down in gradual steps?
Everyone's speculating on. Actually, people are speculating on how high it's going to get. I'm seeing reports the S&P is going to climb another 50% from here, things like that. But all I'm pretty comfortable in saying is that stock prices have such an absurd valuation that real returns for the next 10 years are likely to be negative and zero at best. So, but I think it's unrealistic to expect stocks to stay flat for 7 to 10 years. So more than likely there's going to be a significant downturn somewhere along the line, or perhaps a series of smaller ones, which is actually kind of how I think it's going to play out.
I know some people say either the bus drives over the cliff or you take a bunch of steps, but you still end up at the bottom at some point.
Well, that's a good analogy. I like that one.
Is there anything in particular that will be a bellwether when things are going to turn around?
Possible. We're seeing it right now. Perhaps the election of Trump, perhaps something in Japan, perhaps something in Europe. There's all kinds of elections coming up. Merkel's coming up next in 2017. France's national election coming up in 2017. And Austria, later this month, actually, we've got a new president. It's largely a symbolic position in Austria, but I expect a extremely anti-immigration president to be elected in Austria in the next round. So we'll see. Any one of these kinds of things can trigger something. Don't recall if I mentioned Japan, but certainly the Bank of Japan can do something crazy and start a currency crisis there. So these things have been boiling for a long time, actually. How long we have before the pot actually simmers over or blows off the top remains to be seen.
Should people just take their cash now and wait for the explosion?
That's what I would tell them to do. It doesn't have to be an explosion. Just wait until valuations look more normal. Meanwhile, on the expectation that central banks are likely to do something crazy and there might be a currency crisis, I would tell people to have a portion of their funds in gold, perhaps as much as 20% or more. Depends on what people are comfortable with. But there's absolutely nothing wrong with just waiting for better valuations. Most assets are extremely overvalued here. Gold would be one exception.
Another asset that might be overvalued, Vancouver real estate.
Well, there's no way to short that directly that I'm aware of, but yes. And had there been, shorts would have had their heads blown off, me included, because we've been talking about this property bubble in Canada for how many years now? A decade, at least.
And of course, we know that property values have gone down in New York, London, Miami. San Francisco is still holding out, but is it just inevitable that this luxury property will come down?
Yes, it's starting to now. throw Australia and China into that mix too. Actually, London. So yeah, there's some more price pressures coming up on that front. Ford recently announced a sort of car recession. Don't worry, Jim. It's not a car recession. It's just sort of one. Meanwhile, they announced a Go Further program. This is kind of interesting. I don't think they intended it this way, but I've got this clip of Ford's CEO and stand in front of a big billboard that says "Go Further," and fresh on that, comes news they're moving their small car production to Mexico. This is going to play into Trump's hands, but as long as they're going to go further, why don't they go to China? So the things are heating up in the election campaign too. I really don't think it matters too much to the stock market who wins. I think a bear market is starting here, and but either way, no matter who wins, I'm a big free trade advocate, and it looks like free trade is the last thing on people's minds. Certainly, Trump is running on an anti-free trade platform, but Hillary Clinton has embraced essentially the same plan. So from that aspect, I expect a mess, and the global economy can hardly afford a trade war here. I think one is coming no matter who wins, and symptoms out of the EU suggest the same thing in Europe. If Trump imposes monstrous tariffs on China like he proposes, the U.S. economy is going to collapse whether the U.S. retaliates or not, or whether China retaliates or not. But I think it's highly likely that China would in fact retaliate, and that's how this mess starts. And the same thing applies to Japan. The U.S. is mad at China. The U.S. is mad at Japan. Everyone's pointing the finger because Europe is pointing the finger at China right now because of excess steel capacity. And the irony of all of this is amazing, because the whole world would benefit if China gave away iron, steel for free. That's the simple economics of the situation, but in the name of protectionism, we have tariffs.
How effective is protectionism?
I don't believe it works. It certainly didn't get Russia out of Crimea, did it? Has it, has it gotten anyone out of power in Venezuela? Protectionism usually didn't get anyone out of power in Iran. We've now worked out a deal that we probably could have worked with them years ago if we'd wanted it. So I don't think sanctions work, and in general, what they do is cause wars. If we go back even as far as World War II, Japan attacked the U.S. actually because we'd shut off their supply of various commodities. So they retaliated with planes on Pearl Harbor.
How much of this saber rattling is real? Of course, China was chewed out, I guess is the only way to put it, for creating islands in the South China Sea, but they don't plan to pull out. What can you do about it?
That's a good question, and I don't know how it gets. I wonder what would happen if China said, I'm going to put a little base here and build up one of these islands. I don't know where it goes. And the weird thing is, they're arguing here over oil. They could easily come to some sort of agreement and just say, all right, we'll equally share in letting the two countries drill over there. There's actually multiple claims. It's not just China and Japan, but those are the two big players. The common sense solution says, let's just open these waters up as international waters and let people drill. But that ain't going to happen. Common sense never rules in these matters of national pride.
And China, of course, likes to make long-term plans, 5, 10, 25, 50, 100 years.
Yeah, and they can get away with that for a while. You know, Russia had how many 5-year, 10-year plans to revitalize? You know, it collapsed. China got away with it because of cheap labor costs, a lot of U.S. production outsourced first to Mexico and then to China because China was cheaper. But now what? Now places like South Korea and South Vietnam in particular are cheaper than China. China's losing production to them. And of course, the whole world is losing production literally to robots. So skilled jobs are vanishing. And I think the real downturn in terms of loss of jobs comes when trucking is fully automated, and I expect that to happen. We're looking about 7 or 8 years ahead here now to when literally millions of long-haul truck jobs vanish, and with them some taxi jobs and limo service jobs and probably a lot of other things that I don't even envision, perhaps even pizza delivery jobs by Amazon drone.
New Zealand is already delivering pizza by drone.
They are. It's just a test. We'll see. I've got some serious reservations about that. You know, we can have bomb delivery by drones quite easily. So we'll see if they can work around those problems. But I'll just say it this way: if the economic benefit outweighs the risk of terrorism, then we're going to see pizza delivery by drone sooner rather than later.
We'll have more with Mike Mish Shedlock next on This Week in Money.
GEM International is a new diamond explorer in the richest diamond-producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109-carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Mike Mish Shedlock, editor of Mish's Global Economic Trend Analysis on mishtalk.com. For people looking for an upturn in the oil patch eventually in Alberta, those giant trucks the size of hotels, they're now being designed so they can be driven by robots. No more $200,000 a year jobs there.
That's just a small number of jobs, though. There's not a lot of jobs there, and that's what I look at here. You know, people send me links all the time to stories automating this, that. You know, my first consideration always when I'm reading these things is how many jobs is going to vanish from this. So the answer to that is not a lot. And there's some similar things going on in Australia. The answer is not a lot. Now, it's important to the bottom lines of these corporations. Anytime you can get rid of a $200,000 job or more, that's very important. But we're literally talking dozens or perhaps hundreds of jobs here for a company, not thousands. When long-haul trucking jobs go, they're going to go en masse, and I think we're going to see something like 2 million jobs vanish in a very, very short time frame.
Is the next big job then the IT guy that repairs the robot cars?
Well, how does that differ from just any other ordinary repair job? Actually, the skilled job then will go to someone who's trained in repairing, you know, these kinds of cars, as opposed to, say, someone who knows how to fix a carburetor. And by the way, cars don't generally have carburetors. We have electronic ignition, so mechanics certainly need to keep up with their skills. Are we going to need more of them or less of them, actually, though? That's the question, and my conclusion would be less of them. If people are driving fewer cars, let's say people in cities stop buying so many cars just because we've got all of these taxis on demand and rental cars on demand. Guess what? There's fewer cars. If there's fewer cars that need to be serviced. So there's a lot of considerations there, and any angle you look at this, there's going to be a lot of jobs lost in this. Over the long haul, I believe technology creates jobs actually, but in shorter time periods, we're in a period right now heading into one where I would call a strong period of creative destruction, and there's going to be a lot of jobs lost. The Internet created a lot of jobs. Now it's taking them away. The same thing is going to happen with robotic technology. For a number of years, it created jobs, people designing, building robots, all of those extremely high-paying jobs. Once those robots are unleashed, we're going to see the back end of it.
The EU is proposing that robots be termed electronic persons and be taxed for each job they do.
Yep, and Paul Krugman proposed the same thing here in the U.S. Something like that. I don't know. It's more likely the EU would follow through on something like that, than the U.S. It's certainly not the right way to go. Essentially what they're doing wrong is they're trying to get inflation in a deflationary world. All of these things, productivity enhancements by their very nature, are price deflationary. More people can afford more gadgets because of this over time. If deflation stopped people from buying things, no one would own larger and larger and larger TVs. No one would own better and better and better PCs. No one would be buying phones because there's always a better, cheaper model coming out next year. So the idea that price deflation is a bad thing is easily refuted, yet the economists still stick to it, and it's driving me mad. But that is the source of two problems. One, it propels the stock market higher. CEO wages go higher. The Fed putting all of the cash into the economy has gone, not into price inflation, except in government-controlled areas like education and healthcare, but rather it's gone into asset price inflation that the Fed doesn't even see or count. So it's screwing the little guy who's getting 0% on their money, that doesn't have any investments in the stock market. And of course the Fed, every time there's a stock market bubble and it crashes, the Fed comes along to bail out the banks. So the little guy gets screwed on both ends. That's what's going on. The problem is the Fed, they don't even see it.
And of course now, the banks won't be bailed out directly by governments. They'll dip into your bank account to do it on both sides of the border.
Those are the rules in the EU right now. We don't have those rules here in the United States. I believe those are the rules in New Zealand right now. So some countries have those, some don't. In general, I don't object to those rules. With one proviso, people who loan their money to banks are taking some kind of risk. However, the problem is there's no bank out there, that is operating on a service-based model only that says, guess what? We're not making any loans. Such a bank could charge a safekeeping fee, not make any loans, park the money in cash, charge for services like, checking accounts and ATMs, and I think there would be a demand for that. But it would be actually frowned upon by the Fed if any bank were to organize itself that way. I believe there was one, I don't remember the name of it, doing something close to, but not quite that, where the Fed complained that they weren't lending enough money. So, a bank ought to be a place to save money, and money that's allegedly available on demand should never be at risk of confiscation. But people who buy CDs, people who have savings accounts that allow the money to be lent out, they're collecting interest on that, and they should take a risk. And I don't object to bail-ins, but the system as it is right now is out and out fraudulent.
How big is the banking crisis in Europe?
Huge. The entire banking system, I believe, is insolvent. Italy leads the way in this. If the Italian banking system collapses, it could bring the whole thing down. Bail-ins in Italy are actually highly likely, and it could easily start, some sort of contagion cascade where people pull their money out of banks. Actually, it's going on right now. If one looks at something called Target 2 balances, depositors are pulling their money right now out of Italian banks to move elsewhere in the system because they're afraid of being bailed in, and a bail-in is actually highly likely in Italy.
How much trouble is Deutsche Bank in?
Big trouble. A lot of that is a derivatives mess. Some of it is simply exposure to the other European banking system.
At the G20, some of the leaders talked about the Trudeau solution, which is to build a lot of infrastructure and run up their deficits to protect the economy. Does that work?
Did it work for Japan? So the answer is it didn't work for Japan, so why would it work here? And plus we've got a fundamental issue here. We've got overpaying for labor. We've got union work rules, the demand prevailing wages. So GDP by definition counts government spending. So technically it doesn't matter if government spends $1 billion building a single bridge or $1 billion repairing 20 bridges. It's all the same. And logic would dictate that the more you get for your money, the better off you are. But those who are, just want to force GDP up would say the more you spend for something, the better you are. That's how crazy it is.
Is it more effective to help the economy to cut taxes then?
I would think so. I would slash corporate taxes. I would slash, personal taxes. I would set the corporate tax rate to 0. Right now, we've got a tax structure in the United States that taxes money higher at home than abroad. So you have the Googles, the GEs, the Microsofts all trying to move their profits to EU or to Ireland and to havens in the Bahamas where they've got an extremely low tax rate. Why don't we just have one here? And that would encourage other companies to come here rather than U.S. companies to go abroad. So our tax policy is ass backwards, although the highest effective rate is something like 35%. Who actually pays that? The companies that are stuck here and can't avoid it. The technology companies, who can shift their operations elsewhere, hold their profits elsewhere, they pay a much lower tax rate. So we're screwing especially small businesses here in the United States at the expense of to benefit the huge corporations that have big legal staffs that can afford to figure out how they can claim they're really operating in Ireland when they're operating somewhere else.
Yeah, pretty unusual. Ireland turning down $13 billion in tax money, saying they don't want to chase away the 140,000 jobs high tech has created.
There you go. That's it in a nutshell. So Ireland would rather have the jobs than the money, and those are good paying jobs too, and I don't blame them. The EU is not happy with that. Ireland is actually one country that recovered from the collapse better than the others. Why? Because it had the lowest tax rate.
Right now, we're wondering what's going to happen to traditional investments like mining.
Depends on what they're mining. I see a demand for gold, probably silver. Iron, I don't know. Iron's going to depend on, iron's going to depend on a couple of things. Are we going to have this infrastructure rebuild that needs all of this iron? Is China going to keep growing? Net, I would say China's the important factor here. It had been growing like mad. Well, if China slows and decides less on infrastructure and more on other things, including getting its service economy going, demand for iron is not coming back to what it was half a dozen years ago.
Copper. Some people have called it Dr. Copper because its price seems to indicate the temperature of the world's economy. What's going to happen there?
Again, don't know. Copper has a lot of industrial uses, but likely the same thing kind of applies. Certainly, there were some mega mergers in the mining industry, copper industry. You had all these buyouts in leveraged buyouts. Right at the peak of the commodity boom. Much the same way we had all these buyouts of technology companies right at the peak of the technology boom. We had insanity going on at the peak of the housing boom. And so where's it going to hit next? I think the next big crisis is going to be a currency crisis of some sort or a bond crisis of some sort. And we're seeing some potentials of that right now. Interest rates have gone from pretty deeply negative, almost back up to even in Germany. All the people buying, increasingly negative bonds are now underwater. And if interest rates rise, any further, they're going to have to bail, and which would probably cascade yields even higher.
Do bonds actually set the real interest rates?
We have so much intervention from so many central banks. I don't think anyone knows where the what do they call this term? The natural rate of inflation would be. Various Fed governors, presidents, Janet Yellen have come out and said we think the natural rate is low. John Williams, president of the San Francisco Federal Reserve, said that we need to, preemptively, act on this, and he's looking for an inflation target of 4%. Well, you know what? If we can't hit 2%, how are we going to hit 4%? Does just the announcement that we're going to 4% supposed to help things? Well, if it did, how many announcements did Japan have and reiterate that it is going to hit 2% in the next 2 years? And they've been saying this for a decade, and they're not even close. So, what's real or not? I mean, very little is real here. The central banks are increasingly buying assets. Actually, there's no real pricing mechanism in anything. Not in stocks, not in bonds, not in real estate, not anywhere, because there's central banks' interference in all of this. Take away the central bank, or even take away faith in the central bank, and we have the fuse lit for a massive sell-off in all kinds of things all at once.
Mish, how can people find out more about Mish's global economic trend analysis?
Just do a Google search for Mish Talk, MISHTALK. Perhaps just doing a Google search for Mish would help. I write about 4 times a day on General, and today I think I've written 5 or 6 times already. It depends on the amount of news. Even on weekends, I'm writing a couple times a day. So do a search for Mish or Mish Talk, and you'll find me.
Mish, thanks a lot for chatting with us.
A pleasure to be on.
My guest has been Mike Mish Shedlock, editor of Mish's Global Economic Trend Analysis on MishTalk.com. Coming up, the editor of Rick's Picks, Rick Ackerman, next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is Rick Ackerman, editor of the newsletter Rick's Picks. His website is rickackerman.com. Welcome back to the show, Rick.
Thanks for inviting me on, Jim.
We're taking a look at the latest equity numbers, and so many people are wondering, have we reached the peak of the markets?
Yes, we have. Now, it's hard. I hate to sound so decisive about it because, of course, all of us perma-bears have been shooting for the mother of all tops now for the last 5 or 6 years. But the top's got to be somewhere up here. You're either, it seems like the bulls are sort of dwindling, or let's say the vehemence of the arguments they're making is less persuasive, probably because they're less persuaded themselves. You know, we're into our sixth now consecutive quarter, assuming the corporate earnings are down, but the market is, has been trading near record highs, and it shrugged off 5 down quarters for U.S. corporate earnings. So the story is so bad, and of course it gets worse when you think that there are many would-be monetizers who are finally capitulating with respect to the central banks. Even the editorialists are having the chutzpah to write about how no one really believes the Fed anymore, and more to the point, even if you do believe that they're going to do what they say they're going to do, whatever that is, it's not going to have much effect on the economy. So we've really kind of run out of story here to support the market, and there's still literal support in the form of very low interest rates that allow the likes of Switzerland to gin up money to buy U.S. stocks. They've got a $60 billion portfolio. So, it's hard to say when all that will end, but it's still very much in place.
$60 billion into the U.S. equity market. I guess Switzerland's given up faith in Europe?
Well, for sure. I mean, where are you going to put your money in some European manufacturer? There are, I guess, a few of them making money, but at this point, the U.S. stock market is the standout, and of course, it's for all the wrong reasons. But that's not Switzerland's problem. They just want to be in something that at least is moving higher. And the nice thing about it is they've got no skin in the game. They, as Jim Grant was saying in a recent interview he did, Switzerland literally prints that money. They pluck it out of thin air, and they buy U.S. stocks with it. So if you or I could do that, if we could just go down in the basement and gin up some $100,000 bills and take them over to our stockbroker and have them buy stocks, I wouldn't care which way the stocks moved either. Just as long as you got your money in there working and it didn't cost you anything, who cares?
Also, with negative interest rates in Europe and Japan, I've heard that in Germany and Japan, interest rates have gone up, and they're pulling out of this negative stance.
Well, that would be that'd be big news, if market forces start taking over and pushing rates above the zero line. That's going to subject literally, I'd say, hundreds of trillions of dollars, but it's really probably more than $2 quadrillion worth of borrowing at a slightly higher rate. And of course, at those sums, when you're talking about $2 quadrillion, just a little nudge north, maybe 5 or 10 basis points, that's a lot of money globally. And when you think that the money, there's nowhere that money can come from, if it's the government that's doing the borrowing and interest rates go up, well, how do they pay unless they're doing more monetizing? Well, it has to come out of taxes. So that's why I'm always so steadfast in my thinking that we're going to have deflation come hell or high water.
Well, they just did a study, and something like 1 million Canadians would be in deep economic trouble if interest rates went up 1%.
And it's you get the banks out there, the rabble, saying, just give us higher rates, and they're every month kind of hanging on whatever it is Yellen says. I think she's made about 3 or 4 pronouncements that rates, quote unquote, might go up in September, but it looks like that's been washed out to sea. And when you think of what it would take to put just a little more curvature, a little more steepness in the yield curve so that the banks could make a little money on a spread, it would be a killer for so many others. You know, the banks would make more money and savers would make more money, but where does that money come from? It means somebody on the other side has to be paying for it if it's not being monetized. So you can see where we're in a lose-lose situation. You know, if the government should want to raise interest rates, it will subject all of its borrowing to that higher rate. And, you know, where do we gain anything in the end?
You're listening to This Week in Money. I'm Jim Goddard. We're speaking with Rick Ackerman, editor of rickspicks.com. Rick, the price of oil seems to be bouncing around the $45 mark pretty consistently. Do you see any change in that?
I see it going lower. You know, that's when, like the banksters want more steepness in the yield curve, they even more desperately want more inflation in the oil patch. And it has to do with the reality, for one, that they've loaned very heavily into the energy sector. And, of course, we need high energy prices to support those loans or to support the repayment of the loans. But also, in a psychological sense, as long as oil prices remain buoyant, there's at least nominally the idea out there that we could have a little bit of inflation. So we do have this fervent prayer for energy inflation, but I think it's unrealistic in view of the fact that the world is kind of skirting a recession. We're at the brink of recession or worse, and so it's hard to visualize a strong push from the demand side that would keep oil prices up. So I think they kind of peaked in the low 50s there. I don't see $60 a barrel unless there's some terrorism-related incident. But just on supply and demand, you know, I think that there'll be a lot of weight on crude oil prices in the years to come.
One of the things I've heard about shale oil, too, is that you can virtually turn it on and off, unlike traditional oil production.
Well, that's true. They're very nimble. You know, it's really hard to start up a deep sea rig. You know, when you decommission that kind of drilling, it's very difficult to crank it up again. But relatively speaking, the fracking operations are lean and mean, and the extraction of natural gas is a process that it's more easily turned on and off. And, you know, just with the stability in prices we've had in the range of, you know, around $50, a lot of oil production that had gone offline has come back on stream.
A lot of utilities have applied for higher natural gas rates for this fall. Is that justified?
I guess you'd have to ask the government that. I mean, if it is, I guess we should all be investors in natural gas producing companies. That may be the way to go, and I guess if you looked at Warren Buffett's portfolio, it's probably what you'd find. So many of his companies are just they're regulated, but regulated in a way that there'll always be a profit in it, if not the kind of big one that the private equity investors seem to go for.
I've never seen a utilities commission say, you better lower your prices. They always approve the price hikes.
Yeah, and I couldn't figure that at all. I live in Denver, you know, and my house heating bill from one month to the next was X dollars. I can't remember. My wife pays that one. It could have been $250 a month in the cold months. But when I saw natural gas come down from 12, 11, 10, 9, 8, 7, $6 per whatever a zillion cubic feet, I'm thinking, why don't prices come down? And of course, we used to have the expertise at newspapers to answer that question, but nobody does anymore. The newspapers are all defunct except for covering, Trump versus Clinton. So, you know, nobody really understands it, but for sure, it seems like prices are very sticky coming down, especially at the pump.
You said there's a solution if the equity markets are about to plunge, and it's what you call the Warren Buffett solution to protect yourself. What is it?
Well, Buffett has kind of shied away from the private equity stuff, and it's only because private equity is so greedy and stupid that you could have a valuation of, I think it's $60 billion for a company like Uber. Well, that's strictly a private equity phenomenon, but in this case, happily, all the insiders and the early investors, accredited investors, they're going to get absolutely crushed. But Buffett, for his part, has stayed away from the Ubers, and he's focused on a food chain with the purchase of Kraft. He's got the railroad right-of-ways, and there's no telling, he's making plenty of money just in the rail shipping business while he waits for the rights of way that come with those rail acquisitions to pay off each in its own way, whether it's with fiber cable or whatever else you want to put alongside a railroad track. He also has a chunk of Geico, and, if you play your own life forward, do you see yourself at some point stiffing your auto insurer? We're all going to keep paying our auto insurance, even if we're not eating as well at that point. So, Buffett, he's really locked up the basics here, and even though I would say in the coming deflation, there's no such thing as bomb-proof, he's as close to it as you can get, and he will probably satisfy an idea that I put out there for a lot of years that the coming deflation, let's call it the Second Great Depression, will not be a money-making opportunity. It's not a time when we're going to be able to go out and leverage something. It will be fundamentally a deleveraging process. And for that reason, even the Buffetts, of this world, there is only one of them, but he'll be doing well to hang on to a fraction of his current net worth. But just even 10% of it's going to leave him a very rich man. So I think Buffett is basically hunkering down for the worst. And, for the average investor, I think there's still a big play in long-term paper. That would mean corporate or munis, with maturities of 30 to 40 years, and U.S. Treasuries 30 years. I think the rates on the U.S. 30-year could come down below 1%, with the 10-year correspondingly close to zero. And if that happens, you'll have enormous price appreciation in the underlying vehicle, because price moves inversely with yields. So I feel very strongly that at some point in the next, who knows, 2 years, 3 years, there's going to be a global panic, flight to safety into U.S. dollar assets, or mainly treasuries. So that's one big rally that lies ahead, and even though U.S. T-bonds have gotten pounded in recent months, it's still very much part of a corrective process that has one more big leg to go. There's a big rally that's sitting out there in bonds, and it's going to come from a global panic into the last perceived safe haven, namely U.S. bonds.
Rick, thank you so much for chatting with us.
Well, it's always a pleasure, Jim.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks. His website is rickackerman.com. That wraps up our show. We'd like to thank our guests, Mish Shedlock and Rick Ackerman. And thank you for listening. Questions for the show can be emailed to info@howestreet.com. I'm Jim Goddard. We're back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.